2025. I am Keith Harwood here for Yellow Tunnel and Tradespoon. Normal disclosures before we get started. Options involve substantial risk and are not suitable for all investors. Tradespoon, Yellow Tunnel, and myself are not investment advisors and not registered with the SEC nor FINRA. If you do have questions about your own personal financial situation, please consult with a registered financial advisor. The information in this presentation is for education and information purposes only and should not be considered trading advice. And finally, myself and or the team at Tradespoon or Yellow Tunnel may have a financial interest in the securities presented and the trade ideas. So please keep that in mind as you evaluate anything that we discuss for your own personal investment or trading portfolio suitability. All right, folks, with that, we've got a little bit more of the same. The market had a good day yesterday, rally. We got some good earnings this morning out of Delta. That's helping Jets. The other thing that's moving really this morning is silver. And that's about it. The market is up slightly. We'll see what the intraday reaction is. But yesterday we had semiconductors up, unwinding the sell-off from Tuesday. And we're basically back to where we were. It's just rotation within the subsector of semiconductors. And yeah, looking for those opportunities as always. You know, the market doesn't have a justification for a down move. Fed minutes didn't do it. We got a Fed meeting in a couple of 3 weeks. We got some earnings. That seems to be the one thing that maybe the bear can latch on to. Otherwise, we've got a government shutdown that I didn't see any material updates. Maybe that gets resolved soon. Maybe it doesn't. We got tariffs that maybe get resolved. And the market just says, okay, whatever. It's there. It is what it is. Let's keep going higher until something bad happens. Frankly, I kind of feel like the dip side of things is becoming less and less likely. People are more worried that we get into a more like liquidation, kind of falling knife, or just grind higher. Dips always work to buy, so why bother dipping? If the market is going to take me out of a position on a little bit of profit taking on the upside, so be it, but I don't want to sell down 1%. The stop maybe gets faded down to a lower level for those trying to reduce risk. Don't sell down 1% because that never works. If we go down 4 or 5%, probably got to sell just because it may be a sign of something worse happening. So kind of shifting my thought process again, as always, trying to stay flexible with this stuff, but understanding that probability of success trades still seem to work, but they're seemingly harder and harder to find even with the increased implied volatility, partially because we're starting to come into earnings season. So as we go into earnings season, you know, I don't want to have exposure to earnings-based options trades. So rather than exposing or putting on the risk of an earnings-based options trade, I got to focus on where the opportunity may be there. So stocks that have earnings later, I can look for a put credit spread prior to that, or I can look return on capital in a trade. Maybe, you know, maybe NVIDIA is setting up now. We've been talking about it for a few days and it popped up on Aggressive Power Trader today. So I want to look at that a little bit closer today. UNH also popped up and we kind of talked about that yesterday, but maybe now that it looks like there may be some upward momentum, you know, I can get a little more aggressive with a put credit spread, frankly. It's not necessarily a return on capital trade yet to me. For others, it may be, but I don't see it going parabolic coming into earnings either. So NVIDIA's got some time before earnings. Maybe it can get a more dynamic move since it seems like tech has been where we get those dynamic moves more than anything, whether it's China tech like Baba and Baidu, or semiconductor tech like Micron and AMD and Intel and, you know, yada, yada, the whole list goes on. You know, keep looking at them, keep looking for those opportunities and seeing where we can find some return. All right. The trend is grind higher, right? So instead of consolidation, a complete sideways, it's very grind higher. Low realized volatility for the broad market and that grind higher. So understanding that and knowing that, you know, outright long calls may be expensive as a result of that, tends to lead towards thinking more about the call verticals, the put credit spreads, and maybe stumbling into a return on capital buy a call because we got a dynamic move setting up. Keeping in mind that allowing more time is going to potentially interfere with earnings, and knowing and determining whether or not I want to have that exposure. And again, that leads to more spreads to reduce the Vega exposure as, you know, earnings expectations for magnitude of move shift. Yeah, that's about it right there. So be aware of those earnings dates. I don't like chase trading. I don't like revenge trading. Right now, again, those chase trades seem to still work. Certainly seems like that is what it feels like for like silver right now, is a trace trade to the upside. And I've said a lot of my signals are saying I should be short precious metals. This would be a full-on revenge trade to be loading into that position. So instead of chasing the bull move or using the signals to say, but they have to go lower, my signals say lower, and just say, okay, the signals aren't lining up. The price action and the signals aren't aligned, and so I don't do anything and I look for other opportunities. When the two things don't align, it's not the opportunity. When they line up, I want to be ready to move, but until that point, just kind of check it every day and say, okay, it's still not there, reevaluate later. All right. Yeah, that's the long and short of it. 10-year yield found a floor around that 410 level, bounced back up to 414, doesn't seem to be going anywhere. The bigger range, or the medium, the whatever range is 4 to 420, starting to show some support around that 410 level. Tightening up this range more and more. Maybe we break out in the next few weeks, maybe we don't. We have a lack of data thanks to the government shutdown, so it's hard to really get a big shift in 10-year yield, barring a big announcement from a Fed member or a Fed president or the Fed itself. Yesterday's Fed meeting minutes didn't do anything, so I wouldn't expect to see a breakout here unless we start to get some other data, and that data is lacking due to the government shutdown. So can't assume that anything here is going to change unless something else changes, i.e. resolution of the government shutdown, new tariff news, new Fed news, etc. When it comes to MMFI, slightly better yesterday. Actually, kind of surprised me that it didn't go a little lower yesterday before bouncing, but you know, at the end of the day, because we had a little bit of a bull day, a little bit of bullishness in MMFI, but it's still in the same spot. It's not a 70. It's not showing overall bullishness across the board. It's a lot of consolidation out there right now heading into earnings. A lot of consolidation near the 50-day moving averages, and a handful of names that are exploding. So same story, nothing seems to be changing there for now. And then Bitcoin, the risk on trade or the government shutdown trade or whatever it is, consolidating at highs, setting up a bull pennant here, maybe a little rectangle, consolidating, showing support at 120 in the short term and resistance at the highs. So 120, 126 range, currently trading 123.5. If we get another risk on day, maybe that's the trigger to get Bitcoin up. Again, silver's up. Gold is close to unchanged. That move is feeling a little bit tired with gold not participating, but silver's still going, so it may not be over yet. You know, and we'll see. The RSI didn't get overbought in Bitcoin or anything crazy like that. I mean, I feel like this RSI may need to get to 70 before we hit the top in Bitcoin. But if we start to see some risk off, Bitcoin would naturally fall. Right now, there's some support there. And again, I think that like a stock like MSTR makes more sense than anything else for this Bitcoin situation. Maintaining these higher prices for long enough that maybe the Bitcoin miners and the Bitcoin holders start to get some price appreciation as a result of it. But again, just see how it goes. Close that. We've got the market about a minute to the open here. Yesterday started with a higher low, ended up making a new high barely and closing above the previous day's high. So bull market grind higher. You can see the range is tightening and tightening. Going to be kind of nice here over the next week as we start to remove some of this April 7th, 8th from the 6-month charts. It's going to start to tighten this up, and all of a sudden, you know, the chart range is going to look a lot more dynamic because we're not pricing in these like 10% days like April 8th and the big move from 490 all the way up to 670 over the last 6 months. You can see, obviously, we had a big move. A lot of that was driven by the April to mid-May behavior. As these low prices continue to drop off the chart, it tightens up from showing 500 on the lows to 550 on the lows to 600 on the, or 575 on the lows, eventually 600 on the lows. And it makes those smaller moves look bigger because on a relative basis they are, but at the end of the day, this is again just a grind higher market with a nice bull market ever since the lows on April 8th, with some chop along the way and smaller dips seeming to come into play. And this goes back to that kind of thought process of maybe we don't need to do these dips to the 20-day moving average anymore. When we start to see a little bit of risk off, maybe the sellers just say, I don't need to sell. I'll sell into strength, but I won't sell into weakness. And if we get below the 20-day moving average, get below 665, I may be justified in selling. And if we get down to 655, I may have a panic selling moment. But what's going to trigger that? It doesn't seem like there's anything to do so right now in the fundamental inputs. So if there's no fundamental input causing a falling knife of liquidation, then why chase sell? Even if it's only a 1 or 2%, it feels like a little bit of a chase to sell down and take that profit rather than just participating in the upside and hedging as needed. Again, I think that the hedge should be right now more of a risk reversal. We do have the VIX coming down. We do have skew coming up a little bit. The call is coming down slightly. I think there's more to this. There's going to be, my expectation would be that there should be more call selling into this grind higher move that's not participating with dips. The put buyers to hedge their downside, not necessarily getting paid because we're going up so slow and the VIX is falling, so they may start to shift towards selling calls, push the VIX down towards 15, 14. And again, we're actually seeing a little bit less aggression here on buying the put side as well, which makes some sense, maybe rolling up hedges, but selling of calls to keep the VIX coming down because the VIX is frankly too elevated unless earnings is going to be a really crazy time this year. So we're coming up on earnings, and the first shoe to drop was Delta, and it was good. So I got Delta right here. We'll just show it up 6.5%. Delta's earnings normally have been average about 6.5% for the last 2 years. The most recent stuff has been like 9 to 20%. So it's smaller than the last 3, bigger than the long-term average. Didn't see a good trade here. We ended up settling right into the range of August. Maybe it's going to, maybe this ends up being similar to last earnings where Delta has good earnings and then it consolidates for, a few weeks, maybe gets a dip if we get bad earnings at a United, American, or Love, but every airline is up a little bit today off of correlations. At the end of the day, Delta actually, we know, had good earnings. And just to give a quick thought here, like a 58, 57 put credit spreads around 20 cents. Should be around 20 cents today. Market's very wide right now as people try to get the pricing in line. Implied volatility still has some room to fall down towards about 38. It would be a trade to go a little bit earlier on during the day before the implied volatility drops too much. But I think that this would be something to consider. A 58, 57 put credit spread for 21 cents. 58 lines up below the prior highs right before earnings. It seems like that would be a tough level to breach, barring absolutely awful earnings out of like United and American next week. United, just to note, is the 15th. So next week, American is also, no, sorry, American's the 23rd. So we only have United next week. even with awful earnings, I struggle to see Delta really falling. More likely, American can fall down into that range because we don't have their earnings. Delta should find some support because they already had good earnings, and if it's rotation within the airline sector, Delta would look like the winning stock within jets. So I think that could be an interesting idea today. Maybe a half hour to an hour from now, once the market really tightens up liquidity and we make sure that we're settling here above 60. If we start to pull back to like 59 in the next hour, then it's all quick profit taking and maybe disregard for a little bit and let this settle out where the profit taking off of good earnings, ends up settling in. With regards to small caps, unchanged, down small, didn't make a new high yesterday. It's not the sector to go for right now, right? We're not going into XLF until we see some good earnings. XLV got their move and is consolidating at the highs. IWM just not particularly dynamic right now. Maybe next week. Get through some earnings, get Goldman, Morgan Stanley, JP Morgan all out of the way, and maybe that helps XLF and IWM set their range for the near term. And if they're all like inline earnings with no real movement, look more at credit spreads. If they're all good, that's a good barometer for the economy. So I say, okay, great, bull market continues, but I look at call debit spreads next week. Let the earnings kind of play out first, I think. I should just check Bank of America. Yeah, so it's sitting right at 50 still. Yeah. So a 50-49 put credit spread is about the best anybody could have done on that, but it doesn't mean it was easy. It's just been a stare at it because we're sitting at the short strike, working, but not so much so that it's like easy money. I prefer easy money if I can, but still working, so I guess it's okay. Tech leadership yesterday, better day than anything, got pushed a little bit further above the highs, and within that, semiconductors, of course, had the nice reversal from the dip. So it dips to the 10-day moving average, jump back up to the highs. Now it's at an inflection point. Are we gonna do new highs, or are we gonna consolidate here? I think there's a justification for put credit spreads, but it's again a little dicey. I think the better play overall for semiconductors is to see if those new highs come in, or look for an individual. And because we have it on aggressive power trader today, and because it's breaking out today, and because it hasn't participated in much of the semiconductor rally, I think turning to NVIDIA does make a lot of sense. We started talking about that, or we talked about it a little more yesterday. I think it still looks interesting. Implied volatility here is kind of mid, around 39. Realized volatility has been around 20. Maybe it gets dynamic and starts shifting up that realized volatility to 36. That's still below the implied. So the delta of the trade is the bigger net impact. I don't want to go all the way to November 21st. For a call vertical, I think the November 14th makes sense. And I don't have to get too crazy here. I could just go off of a pretty traditional analysis with it and say, I want to sell around a 30 delta call, which is 205. Want to buy at the money, either 190 or 195, probably 190, maybe 195, and look for some appreciation there. 195, 205 is 370. It's got about a 2-to-1 risk reward. Risking 370 to make 630. Not that I would ride it all the way out to the 630 profit point, but for semiconductors to continue, I do think NVIDIA has to participate, and so that would be the more interesting setup than SMH to me at this point, is focusing on NVIDIA, looking at a slightly in the money call, selling it slightly out of a little bit further out of the money call, like a 30 delta call against it, and seeing if this catches a little bit more here now that we've broken out to the upside. A put credit spread type trader would look for 182.5, kind of use this previous high around the 185, 182.5 range. For next week, it's 40 cents. It's 20% return on risk. that's right at that like reasonable level of 20% return on risk. Would I prefer to get like 50 cents? Sure. But market doesn't give that for the 182.5, 185, 180, 185, 182.5 is about 50 cents. That's a little better return on risk, but the higher probability of success from a 182.5, 180 is certainly there. And that seems to be kind of all I can achieve from a put credit spread. From a stock trade, you know, the risk is down to 182.5, $9 of risk for maybe $13 of reward. So it's about, you know, the stock trade is a bit about a little bit higher potential return, but it's also a bit about higher probability of an upside move now that we've got good support levels below and we're in price discovery mode. When we break out, that's the whole goal. We're in price discovery mode. Where is the next seller? Big names do tend to have sellers along the way. 200 is a natural selling point. That creates the symmetrical upside versus downside for 200. For a little bit extra room up to 205, it's within the realm of possibility, and so it becomes something of potential interest. My preference of the three setups right now is the call vertical, then the put credit spread, then the stock trade, but to each their own on what they're comfortable with in how they like to go that route. I think the highest expected value, the best, you know, potential trade is the call vertical, but you know, everybody likes their own style on this, and any of those can work. Any of those can have the higher expected return because we are in a bullish setup today. It's just about trying to maximize that expected return, and I see that the best with the call vertical. We can go to the spiker, which is AMD. Made a new high yesterday. It's just too crazy for me. So kind of leave it at that, frankly. It's just not my style. I don't know what you guys would think on this one. Personally, I'd be struggling with my stop here, frankly. I'd say, okay, well, if we get below the Monday high of 226, that would be a natural stop point. It's very aggressive, and it can happen off of almost random walk at this point. That's only 4%. Really giving myself a lot of room. I'd want to go all the way down to 203. That's a long way down. I don't want to go that far. Implied volatility is huge. Realized volatility is huge. I don't see a trade here. So others may, I do not. But it's something to watch at least, potentially too, because if AMD starts to reverse, that may be a signal that all the semiconductor money flow is coming out. You know, and then there's the other names like SMCI has participated in this bump. It's in a nice trend, but I think there's going to be resistance at 62. Again, I don't really see much there. Intel has been in a nice bull run, and maybe this is, you know, sort of an example of how AMD can work out in optimal scenario. You get the gap up, a little pullback, new high, then a pullback, then a new high, and then consolidation. If AMD is going to kind of follow that sort of pattern, this 10-day moving average becomes support. It's got to come up, and it's going to take some time to do so because, you know, 10-day moving averages take a few days to run up. 20s take a few days longer. 100, 200-day moving averages take a long time. So my real bigger support levels below are still well below the other price points from the last week of trading. Again, making that a little tough. And Micron, another one that's been in that run mode, consolidating near the highs again. And NVIDIA looks like it has just more upside than the other names at this point. So to address the other aggressive power trader names, we got SRE, utilities. Another time that utilities come up, utilities have been in a bull mode. People are still using that allocation for some safe haven when they're not going into higher risk. So it seems like we're going to the two extremes: high risk with tech and safe havens with utilities and gold and silver. You know, maybe utilities actually have a correlation to the precious metals trade right now. Too overbought. 70 plus RSI does not last long in XLU. I think that there's a chance to buy a dip here. I just don't like to buy breakouts in utilities. So while SRE may be good, it's not my preference to go that direction in a utility right now. I could try to find a different name that's not quite so overbought, but if XLU pulls back, they have pullback too. They just may have a smaller pullback. So it gives me a little bit closer defined risk. Just not a real shot to sell put credit spreads because they're generally low volatility. So, Duke is an example of that. NEE is more like XLU in that it's way overbought, high RSI and scary. EQT, in the energy spaces, we're kind of talking that stuff through. This is natural gas. So part of that AI demand plus the energy side of things. So the power generators, they've got a low cost of production, consolidating near the highs. Above 57 starts to look really good. So we're really right there. Tuesday, I thought this was starting to set up really nicely. Yesterday started looking like it may reject that high. Right now, we're setting up an ascending triangle. 57 is the ceiling. The 10-day moving average is the floor. Usually I look for these to break out to the upside, not the downside, because the downside just isn't a good dynamic trade. But if it does get that breakout to the upside, a call vertical targeting 61 makes sense. So like a 57.61 call vertical, a 58.61 call vertical, 58.62 call vertical, any of those sort of ideas. Understanding that we've got October 21st earnings, so it's a shorter term trade. In October, I don't want to sell the 61s or 62s because they're too cheap, and that may be a little too optimistic. Traditionally, I'd look for like a 59.5 to get that, 59.5 to get the right delta. You can go up to 60. Up 30 cents, this should be trading up in the 30-cent range, or 30 to 35 cent range. And so that it does give enough premium to justify a call vertical like a 57.60 or even a 57.5, 60 or 58.60. 58 may be a little bit too high, but 57.60, 57.5, 60 can work really well, I think, in that scenario. All right. And then finally, from the aggressive power trade list, UNH. So UNH is holding, catching that bid, and people are getting more and more confidence here. So what do? The put credit spread idea for me has been down in that like 330 range, maybe up to 340. That's a bit too low to sell a put credit spread right now. So forecast toolbox, was looking at that this morning. We're looking at consolidation and bullish, followed by bullishness, a model grade of B, low range 365. I can go conservative and say, okay, can I sell a 360, 357.5 put credit spread, a little below the lows of the range? And if we breach 365 and maybe signaling that the model just didn't have it right, one of those 25% sort of scenarios of being wrong. And so going out to next week, a 360, 357.5 put credit spread is 50 cents. All the stuff kind of lines up. It's right back at that 20 to 25% return on risk. If the model's right, it's good. It's been one to watch. And now that I'm seeing the model lining up, I get a little more confidence on saying, okay, maybe I can be a little more aggressive here. The highs of that September move was around 360. We broke out yesterday. Didn't love it yesterday, but maybe now that we're getting that breakout, we're getting that, the reality may be that we're starting to go, oh, good. God, sorry, I just looked and gold's starting to reverse here. Does that mean silver's coming down too? Silver's starting to come back down. Maybe that was that ultimate spike high and then fade here, and this is the end of the precious metals trade after all. Not today. Sorry, just shifting got distracted by that. So UNH, I think the 360, 357.5 put credit spread for next week can be a rational thought process. And then coming over back here to the precious metals tomorrow. So today, maybe gold goes down $5. And I feel bad about missing out on the first $5. And we're back to where we were on Tuesday, or even a little bit above Tuesday. By not engaging after a couple of times I tried, I've missed out on a lot of losses on the bear side. But if we start to get this reversal and we start to see more signs that those other correlations holding, like FXY continuing to show weakness, this normally shows weakness for gold. TLT continuing to show some weakness, at least on a relative basis, that tends to be weak for gold. UUP tending to show strength, that tends to be weakness for gold. We may be lining up for a liquidation mode in precious metals as we get panic that the buyers of the last week or so didn't take their profits and or start taking some losses. Buyers yesterday, right now, may be feeling a little bit dicey, unless they were bears just covering their position and being like me saying, I'm done with it. I don't need to re-engage a short, but if I've been buying to get long, I don't have a ton of confidence in myself if we drop $3, $4, $5 today in gold. Okay, so yeah, the bag holders. That's thank you, Mario. The bag holders. You know, the old phrase of bulls get paid, bears get paid, pigs get slaughtered. Now, in this case, the bears aren't getting paid. The bulls have gotten paid, but at some point, got to take those profits. Otherwise, you never get paid. It's all on paper. And it doesn't even feel that bad to sell for profit taking at 365 if you've been holding for 2 months. Feels bad selling at 365 if you've been holding for 24 hours, but if you've been holding for 2 months or longer, you know, being a little bit, taking a little bit of profits and saying, okay, I've gotten a lot of money here. I need to book some wins. Still makes sense at 365. At 340, it may not make sense, but at 365, 370 range, I think that can make a lot of sense. So if there's a lack of buyers, now that we've made the highs, if everybody's in the trade, that's where you have that potential for the spike down. It's probably very expensive, even for next week. Still very expensive, justifiably so. I don't want to go down to like 350 puts that are really cheap dollar-wise because they're just so unlikely. I'd be looking around the 360 level. Again, maybe it's a tomorrow trade. I think tomorrow trade. Because if we fall today and then just bounce right back tomorrow, then it looks like what SMH just did, right? We fall, people panic that was the end of it, and then we rally right back up and say, oh, never mind. Panic selling doesn't make sense in what's been a bull market. But continuing to hold after 2 days of pain, that doesn't make sense either. 1 day of pain, a lot of people can say, okay, it's just a blip. 2 days of pain, and people start to get a little more aggressive with it and say, oh gosh, I don't want to miss out on the selling opportunity. So if long, I'd probably be selling here. I don't want to engage on the short until we see 2 days of down. Okay. Might just be getting started, may just be a blip in the window, much like we've seen before. A blip that then recovered by the end of the day. And then consolidation as we say, okay, maybe it's a good time to take some profits and consolidate. So if we like dip down to 363 or something like that and then recover to 370, I'd expect consolidation. If we dip down to 365 and hold down there, that's a good starting point for the bear to start thinking about it for tomorrow. That goes back to that NEM trade that we were looking at. I think it was last week. Like this could start to look down towards 75 if gold goes into liquidation mode. So I'm avoiding all things gold related. For the bear, I would focus on the gold or silver trade as opposed to the gold miners, but to each their own on it. You get the better liquidity in those. And sometimes we see that disconnect where people hold up some of these producers, miners, etc., even with the dip. And I think a prime example of that was USO, got down to lows, and like XOM broke with it, but not quite as aggressively. And HAL held up fine. Still trading 24, still in that dicey mode, but never got the pure liquidation. So to trade like correlation of correlation of correlation is a bit harder, right? I'm saying gold and silver should drop because of TLT, UUP, FXY, and thus miners should drop if gold drops. Now I'm saying because I see a drop in TLT as an example, I'm leaning bearish in gold. Because I'm leaning bearish in gold, I'm leaning bearish in NEM. Because I'm leaning bearish in NEM, I'm leaning bearish in yada, 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 and it's just a little too derivative. The correlation, I want to just go one step out instead of going multiple steps out and going into the minors. As it starts, if it starts to come through where gold breaks and some minors hold up, that could be a follow-on trade, but the first trade, I think, should be in the actual precious metal itself. Whether it's gold first, silver second, miners third, something like that, you know? All right. Most of the recap done there. Pepsi up small on earnings, a nothing move. Sure, 138-ish looks like support, slightly bullish earnings. It's a nice reprieve there. 138, 137 put credit spreads, 24 cents. So news is out. That's the easier money now. There wasn't a great trade for earnings, but reaction to earnings now, selling a put credit spread like 138, 137 or 137, 136 looks okay. Much like Delta, Delta bullish earnings, Pepsi slightly bullish earnings. We're not in a catastrophe mode. You can look at the put credit spreads there for that kind of concept. Now that the fundamental news is out and the range is generally fairly set here. All right. Oh, and then the last recap on before I forget, Capital One, still don't see anything to do here. Yes, we're consolidating. Yes, we've got earnings next week. And no, I don't want to do anything because financials aren't going anywhere, but maybe they do decide to go somewhere if we get a fundamental input ahead of earnings tomorrow, or tomorrow's options don't give me enough premium, and next week's options have earnings. So more of the same there. EEM maybe shifting a little bit down, but overall fairly neutral. Again, nothing dynamic here. Too low of implied volatility to really sell a bunch of options under the risk that we have something break next week. So still nothing I like there. GE maybe on a dip can re-engage on a put credit spread because we're starting to dip a little bit. It's a very slow mover. 290 or 292.5 put credit spreads could make some sense. 290 is 38 cents. Might like a little, I think I like a little more premium because ultimately I prefer 282.5, but 290 is starting to look decent based upon the low of September 29th. A little more dip though, because I can see this very easily getting back down to the 20-day moving average at 297. That $3 may not seem like a lot, but on a 290, 287.5 put credit spread, it adds 12 cents. So instead of selling for 37 cents, I'm selling for 50. Now I'm at my 25% return on risk. Now I'm getting a decent return there. 37 cents is a little on the low side. Getting that extra dime adds up. Morgan Stanley, another financial that's not really going anywhere, but it's not going up. If anything, it's testing. I mean, it's testing the lows, obviously. Earnings next week. No opinion for options for tomorrow. So nothing to do there. And then SMH, which we started to address a bit here, testing the breakout. And I think NVIDIA being in the aggressive power trader makes more sense than SMH itself. So long and short of it is aggressive power or weekly power trader. I don't see a lot right now. Aggressive power trader. I think NVIDIA for a call vertical can make some sense. SRE, too overbought, and UNH maybe looking towards a put credit spread with a higher strike of a 360, 357.5. Okay, so one put credit spread for aggressive power trader, one call vertical for aggressive power trader, and a bunch of hanging out for the weekly power trader. All right. What else have we been talking about that has been interesting? Frankly, not much. So let's go to quantum computing. That was down yesterday. So buy semiconductors, sell quantum. IONQ down a little bit. QUBT just shopping still here. The bull is holding in, but not pushing to the highs after that private placement that pulled us back on Monday. I still think that there's a decent chance of retesting 24 to 25, maybe even 26. Call vertical can work, but I'm paying theta while we're not moving. If we have from now, if not in, looking for more like what we saw on October 1st, where we find that buyer level and then have a higher high, close near the high. So like if today we hang out here and then close tomorrow around 21.5 to 22, that's a potentially good time to engage on the bull side for a call vertical up to 25, 26. If we close around 22 today, maybe enough on its own. But I think around that 22 level looks like an engagement point here. It's not to sell out if already long until we get back below like 20. The new long, I think, gets engaged around 22. Some of the other names, Rigetti just holding up at the highs and making new highs. So that's a good sign, I think, for QUBT, QBTS. Also, it's kind of a similar setup, somewhere between Rigetti and IONQ holding up near the highs. There's still some desire for risk within the quantum space. And, for the biggest one, it would be IONQ. We get below 70, it's a problem. So the bull, I think, has about a $5 upside, $5 downside in the short term. Looking back to the previous highs, 80, 81 range, actually up to 83. Risk down to the 20-day moving average at 69. So about $6 of downside, $6.50 of downside, $7 of upside, kind of a symmetrical setup. But if the risk is going on, there's a higher probability of the upward move. I don't think I'd go for, is there enough premium for a put credit spread? Enough premium for a put credit spread. It's just, it can get dicey if we get dropped because the liquidity is not great here right now. You can see 30-cent wide markets on $2 wide options. Definitely a spread-based trade if going into the options to improve the liquidity. It seems aggressive to sell a 68, 67 put credit spread given the potential for these kind of names to have liquidation, but it may be ultimately the best return on capital. So the risk is more on the liquidity side of things as opposed to anything too crazy. The put credit spread, the risk is more liquidity based than like random walk behavior kind of based. So if a liquidity gap comes up, that's where I've got my problem more than anything. So we have all of a sudden down $5 in one day, liquidity may dry up in the options and I may be paying a big premium to get out just to cross the spreads. So I have to be able to manage and massage and exit if the top actually comes in. But yeah, I feel like that's the biggest risk with IONQ. It makes it a little bit harder for me to justify making the trade when I think that there could be a liquidity issue in the case when I'm wrong. I'm okay with liquidity issues when I'm really right. I hate liquidity issues when I'm really wrong, and that's the danger of an IONQ or some of those other names. Where the downside could get scary. Like QQQ, if we get into a drop 2% type day, there's still good liquidity. IONQ down 5% in a day. Liquidity starts to, or 7% in a day, liquidity can be a concern. And so can I hold through the liquidity gap, wait for it to resolve, and then get out? Because that's what I have to do. Otherwise, I reduce too much of my expected return. All right. Okay, let's see. So this morning, everything was looking green and now everything is looking a little red. What does that mean for this market? High yield down 20 cents. That can be concerning as a signal here. That's some risk off behavior there. It's a low volatility ETF, of course, because it's bonds, but it's high yield bonds showing weakness here. It could be another concern for the market, a yellow flag, creating a lot more of that mixed signal setup, right? We got some bullish indications, semiconductors looking good, that's risk on, Bitcoin consolidating near the highs, that looks strong. And then I got high yield falling, and you got, some of the other chase trades that have been working starting to fall, gold. Actually, Bitcoin starting to pull back a little bit here. TLT still not moving, dollar still not moving from the open. So another mixed bag day. Not a return on capital day, right? Not a buy all the calls because we're going to spike day. It's peppering in a few put credit spreads where I see the opportunity. AI looks okay. So PLTR consolidating UI path, giving the combination of AI and healthcare getting chased up a little more. What's Pony doing? Consolidating, and then the bigger companies consolidating, dipping. And is it enough of a dip? Wait for the market to tell me, and we're still doing lower highs and lower lows. I got to get the bull flag to feel like it's enough of a dip. What about Meta? Nope. Just nope. What about big tech? Since we've looked at Microsoft and Meta. Apple just doesn't go anywhere right now. Enough premium, yes or no? Barely. Yeah, so it's right there. For some good liquidity, Apple staying above 250, using this dip to just say it's random behavior. It's not a signal that we're getting like tech liquidation here. September 24th low is 251. Next week's 250, 247.5 put credit spread is 48 cents, almost 50, so 25% return on risk. Yep. It's okay. A lot of okay trades out there. Not a lot of great trades again. Right now, I think my favorite idea is probably the delta put credit spread post earnings. Applied volatility is going to keep falling. It's down another 4% since the open. I don't have to be too crazy here to sell a 58.57 put credit spread for 21 cents, 25% return on risk. I have to get back below the pre-earnings highs to take that loss. It's only a week and a half. I only have one earnings in the airlines United to worry about. That's the current best out there for me. Pepsi, unchanged day, but it was already off on the lows. It may not be as good for a put credit spread, frankly. Getting a little more selling during the day. And if the market starts to pull back, it pulls it back more aggressively. And NVIDIA continuing to follow through this morning, so they may already be running away. Delta may be the best because the other ones are starting to run away in the first half hour of the day, or eliminate themselves. Like Pepsi kind of eliminating the put credit spread. NVIDIA getting maybe a bit too much today, now up almost 3% already. Blah. So Delta, that's the one right now for me. DHI, another weekday for home builders. That's another potential cause for concern. Seeing home builders down, seeing high yield down, may not flow through to tech, or to jets, but some little bit of yellow flags here for economic indications, like FedEx. That's probably weak today. Yeah. Not terrible, but not going anywhere right now. Not a tradable anything there in the chart, but let's see what else Forecast Toolbox has for some high probability setups. Let's look for some names. Seagate. Not doing that. Power. Palo Alto. I'll look at that. I haven't looked at that in a bit here. Boeing, sure. Let's take a look at that. Caterpillar, why not? It should give us a nice little, and Boston Scientific. Let's look there. It should give us a little peppering about ideas here. SDX. That looks like a put credit spread from the projections. $215. Yeah, keep hitting the wrong tab there. Not my favorite. Let's go PWR, a little more like EQT. Spiked yesterday, pulled back a little today, holding near the highs. Let us see. $3. Let us see. 410, 400 put credit spread. That gets us pretty close to the 20-day moving average. I was looking at November, that's why. Nope, never mind. Never mind. Palo Alto, that's a bull trend projection. And let's see what we got here. Yeah, I'll come over to ARM here in a second, Mario. Thank you for noting that one. Overbought, bullish trend, boring. All right, ARM. What is our options action today? Lots of calls. Lots of calls. Let's see where we're at, where those are coming from. October 31st, 180s. Buyer, maybe already a seller. Let's see. 180s. Early buyers at really good levels, 5 and 530. They maybe already profit taking at 730 because they got 50%. Man, they got in great levels. You get $2.50 of appreciation if they were the buyers on lows. That should have taken like a $6 run to get there. So somebody bought the lows and sold the highs today already. Good for them. Wow. Nice way to make a quick 120 grand on 600 contracts. Their earnings are in a month. Nothing to worry about there. Sorry, stock chart here. Let's see. You can kind of see like the net is implied volatility dropping here. A lot of volume. It generally looks like called buyers, but already taken some profits. So quick flip on some of these options for somebody. Doesn't look like they're building the position, frankly, but it's on the call side. That generally has a bull lean to it. And that implied volatility is getting hit here. This must have been mostly a more seller than buyer, so buy riders. 150, 149 put credit spread for 21 cents. Gives me a lot of wiggle room here for a pullback, and just that feels like that feels safe. Down around the 20-day and the 10-day moving average for a 25% return on risk. That feels like the safer way to play ARM right now. You know, I'm not like the dynamic trade yet. Implied volatility dropping more would be nice, but is there something going on with ARM with like a takeover projection or something? Because that implied volatility for this week is really high. And looked at ARM, so I don't know if there was like a takeover rumors or something weird. But that would be what I would have expected given the short-term implied volatility bid here. And then people just selling out some out-of-the-money calls, near at-the-money calls to capture some premium prior to expiration tomorrow. Although the more they're selling, looks like it's October-based. So that's got to be these 175 and 180 calls sellers. So yeah, I think, you know, if anything, maybe the put credit spread, the 150, 149, 21 cents. That could be it. Maybe some AI partnerships. That's been the big thing, right? Like OpenAI investing in AMD, or the government investing in Intel. So they're based out of where? Cambridge. Yeah. Go Japan. I don't know. I'd just say the put credit spread doesn't look too bad, and I'm not going to have an edge on the fundamental news, but if they have an AI partnership in the next week, it spikes. My put credit spread goes to 0. If they don't, got a lot of support to break through to get below 150. So put credit spread feels like a relatively safe one. Big presence in Austin, Texas. Yeah, well, I guess that's something that may attract some of the investment community, being a U.S. based, you know, a lot of U.S. based elements to their business. So yeah, maybe there's something going on there that's expecting news, but if the news doesn't come, what happens? And I don't think it goes below 150. Maybe it goes to 160, 155. Maybe it does go below 150. But you know, it needs news to go to like 220. The downside is about, you know, what happens if we continue as we currently have, where it's no news at all. Maybe a little drift lower because people are waiting for news and didn't get it, so they move on. So yeah, I think, you know, probably more of a put credit spread. If we get above 170 just off of like investment flow coming in, it starts to indicate that maybe there's something brewing, and can look at the call side. That implied volatility is so high relative to the realized that you know, it's got to be like on the news to get in, or on like right before the news to get in. Getting in and paying theta for a week or two hurts, right? All right. What else were we looking at here? Pan W, I didn't see anything. Boeing, blah. Blase, 212, earning next week. $0.40, right about 20% return on risk, slightly below, starting to dip a little more in a 212, 210 put credit spread. Not quite there. Caterpillar, another one that looks like a put credit spread projection, but supports like 480. $0.40, same number. A lot of 40-cent put credit spreads on $2.50 wide verticals. Another one that looks like it's going nowhere in Boston Scientific. The risk is that liquidity gap that happens to drop it to 90 and then immediately bounce back. But the 95, 94 put credit spread, probably the same, 20 cents, 20 to 25% return on risk. So a lot of those sort of things out there, right? It's a question of how likely is it to hold the support? Because if we get below 95 in BSX, we may have a liquidity gap. Delta looks better to me than BSX. If you like BSX, though, the put credit spread can make some sense. For the bull, I think we got to get above 100. So that's a quote unquote long way away. It's $3 away. Then above 100, I look for a vertical towards 106 on the call side. Mid range, not all the way to the highs. So start getting bullish. Earnings next week. So, or sorry, in 2 weeks. So put credit spread, maybe for a week, 21 cents. If I had to rank it, I'd say Delta's better. All right, SC starting to fall. Wasn't that on our list a few days ago? Or I just see that somewhere else? Maybe it was because of SRE being on today. Nothing there. It was ES, which was on our list a couple days ago. You know, all these SRE, SE, ES, yeah. Jumbling, another utility that's just consolidating. Yeah, say, you know, from me right now, the three that I think best, I'd say Delta number one, 58, 57 put credit spread. Although now may wait a little bit longer as we start to see more pullback. A little bounce back up towards 60.5 is kind of the spot, if not already in. I mean, I think it's decent already, decent here. Don't want to jump on it again right now, but 58, 57 put credit spreads 28 cents. Let's see if this holds. May shift a little bit here. You get below like 59, it gets a little concerning. I'd still wait for 58. Just trying to figure out where to optimize an entry point to get further confidence again. I don't think it's too low, but too low to enter, but too much more profit taking, and it may start to look like some of these other earnings where you good earnings and then sell, sell, sell. GE. Let's go back to that again. Yeah, now getting into a spot where it may be good. Let's see, 290, 287.5. There's nothing changing. Yeah, 50 cents. So now we're getting in that range. 50-cent credit. And yeah, 290 looks like a good level. If we get below 295, it's a bit concerning. We're only down 1.3% today. It's a bit bigger than what we've seen recently, but not by much. If we were to get down $7 today, that would be cause for a little bit of alarm. But right now, it still seems okay. So yeah, I think that's in that right spot where it can be potentially entered. If we go down too much more, may start to feel like, oh, I got to hold off. And if we start to bounce back up, I don't get enough premium to enter. So we're at that right point, probably in terms of return on risk. And then just making sure that we don't have a $7.50 down day, because if we do, that may be sign for some more aggressive selling coming in. But if we're down, you know, $4 or $5 today, that's just a good spot to be buying in by selling a put credit spread. Not to say that we're going to go to a new high, but to say, you know, no reason to go lower, and this is just random here, you know. Uranium up another 2% today, but just testing the highs. What CCJ got? More of the same. Options for next week are 90, 95, and 100. We may go for a run next week. Implied volatility is very high. See that we haven't moved for the last 2 weeks, but people are owning and holding those calls on the upside. So, you know, the expiration weeks can be very dynamic in CCJ as people play around with those bigger open interests on the call side. So next week could be an interesting week for uranium and CCJ just off of the options OI and the expiration timing. So maybe something to play around with next week, or even, can I finance it? No, not really. It's only 42 cents. Next week is $1.66. Guess I could, like a 90 calendar. You know, buying the next week's 90 calls for $1.66, selling tomorrow for 42 cents. It's $1.25. I'll collect a little theta for a day, and if we go bullish tomorrow, may have to just take the exit on that and shift to something else. But more likely, I think the dynamic movement is next week as we get to options expiration. Like if I was going to grade it as an A through an F, it's like a C plus. So it's an okay trade, nothing great. Any others you guys got right now? Because we're up to 10:25. Just a note, Vlad is traveling, so we got no closing bell. So actually tomorrow we're going to be off, no morning or closing bell, but we'll be back to normal schedule on Monday. So just to have that to note. But it doesn't seem like there's anything major going on. If you guys have questions, you can always email us, Keith@yellowtunnel.com or Keith@tradespoon.com if you want to hit me up. Happy to address via email. But I'm going to be a little bit in and out tomorrow. So I don't want to leave you guys hanging though. If something comes up and something weird is going on in the market, you can always hit me on email, and then we'll take it from there. But yeah, I mean, overall, kind of another boring market, but they're starting to get a little bit more put credit spreads today finally that look okay thanks to a little bit more consolidation and maybe that little dip in Qs that is not cause for major concern yet. The biggest concern I've got for something that I got to keep watching is like HYG falling. This high yield pullback may be a sign of some broader economic concerns. But it's not quite there yet, but it is starting to look a little dicey, that big old 0.25% move. So yeah, I guess, yeah, to summarize again, I think the Delta put credit spread is probably my favorite trade of the day. So at this point, and maybe NVIDIA, although NVIDIA is getting harder and harder to get into just because the stock going up a little bit more, like down around 193. It's just, it's massaging for nickels. But the November 14th, 195, 205 call vertical, now 410. It's 370 earlier, 410 maybe a little bit on the high side. Down to 370, 380 range, it feels a little bit better to get a higher reward. And one of the other things I like to do with names where I'm trying to get in is pull up my expected range for the day, and the estimated high is 195. So buying around 194 to 195 range. Sorry, estimation was 191. So yeah, it looks like it should shift a more bullish setup going tomorrow, but we're on a high point here already. We basically got to yesterday's expected high. So getting in here, maybe not the best entry point for the day, down around maybe even 192.5 or 192. Feels a little bit better. Don't want to wait for 190 because then we're back below the October 2nd low. And I would anticipate that if this is going to be bullish, we're going to hold above 191. Yeah, is Delta giving up a little more? Still okay. So the last had whatever 10 minutes, we've had a little bit more profit taking. It should hold because it had the good earnings, but if whether it should or not doesn't mean that it will, right? It's okay right now though. Tried 59 and bounced off quickly. That's a good sign. Still like it. Just have to see that seller stop moving on this. Right now, they're still there, slightly engaged, but not crazy. Probably not getting helped by the S&Ps dropping 0.25%. So people a little bit hesitant to buy here, it seems, overall. But, as long as all this stuff stabilizes, there should be some support here for Delta off of good earnings. Should be. Yeah. Doesn't always mean there will be. We saw Microsoft have great earnings and then fall relatively quickly, somewhat surprisingly, right? That was a couple months ago, but the really good earnings pull back and then just grind down. But, the whole idea is similar to Microsoft. It did hold above the earnings, pre-earnings high, at least for a few weeks. So even in the case where you get that big pullback, more often than not, I see that the pre-earnings high hold. Doesn't mean it works every time, but it's a higher probability of doing so in general. Yeah, and now Delta back up to 59.5. That's good. That means the seller is not like just hitting every bid, maybe taking profits on little bounces, but not hitting every bid. So that could be good. Yeah, 32 on the put credit spread. It's come up with that dollar drop, but it's a price point that is really quite attractive. So really, really interesting here. The put credit spread got a little higher than I expected, but that doesn't mean necessarily a bad thing since bad if already in, but it doesn't mean that it's still a good trade. It's just a matter of when to sell right now. And I think right now may actually be pretty good as we start to sort of stabilize here. 32 cents, yeah. I mean, that seems like too much. This implied volatility should drop another, what, 5%? Is that what it said? Yeah, 5, actually more. 8%? Probably 5% today, 8% by the end of the day tomorrow. So, so a little bit of vega in that, not a huge amount, still only a 36 delta. Yeah, I think I still like it, even though there's profit takers that are pulling the stock down here a little. By the end of the day, I would be surprised if it's trading over, higher by the end of the day, in the 35 to 40 range. But again, it's all about probabilities. And the probability to me says this should hold and be a good thing to sell. Just we'll see if this is the ultimate high or not for the put credit spread, ultimate low for the stock. And GE close for the entry as well, yeah. So we're getting right around there. I think it's getting a little closer, a little more interesting. Oh, and NEM is actually now falling more than gold. So NEM is now becoming the bigger move instead of gold first. Now gold's down $3 now, but silver, definitely not the second break. It turned out gold miners starting to break before silver here. But that's generally a good confirming signal if we're getting out of gold. If people are getting out of gold, people are getting out of miners. Quick check on something. No, those are expensive. Wow, 45 cents. Never mind. 18 cents for the 44 puts. Never mind. I mean, we may get to like 43.5 tomorrow, but I was hoping to see something, under a dime on the 44 puts and under 20 cents on the 45s to see if I got lucky that the market was pricing in low volatility there. Credit call spread maybe very short term, like a 46, 47 for 21 cents. Does not seem likely that that takes out, and there's decent open interest here at 46. It's, you know, we were above 46 today, but those prices now seem behind us after we get this. I got to stick with my thought of giving it a day. Got to give it a day. I'll stick to my guns and say give it a day. And if gold breaks to 355 today, you know, so be it. It just means I'm looking for more of a put vertical instead of an outright put for the leverage move down. But I feel confident with it breaking further. So, yeah, if it settles around 365 today, that's like almost the optimal for me. And then I got a really good confidence for you know, next week type trade for GLD with a October 17th or an October 24th put type trade in GLD, maybe SLV, probably not the miners. All right, guys, I'm gonna let you go there. We'll see how things go today, how things shake out. But right now it seems like, yeah, Delta bouncing back up. That helps a little bit. I think that's where that feels like one of the safer trades, even though it got a little dicey there for a minute, and seems like that now found its support and found its buyers and stopped its sellers. So thank you. Thanks again, everybody. Have a great trading day, and we'll touch base soon. Thanks again.